Hello, everyone. I'm AJ Cradafil, Managing Member of Vital Wealth Management. Thank you for joining today's webinar. More importantly, thank you for being clients and investing with us through these turbulent times. My goal is to provide some context around the recent market events and what history might tell us about where we go from here. Let's get started. Topics for today include the U.S. economic growth, inflation, bonds and the federal funds policy, and U.S. stock market. So the markets are frightening, but don't panic. It's Halloween time. This is the front of, we're a Halloween household, and it's pretty frightening out there when we look at our statements in the markets, but do not panic. We're technically in a recession. So economic growth and the composition of GDP. What we'll see here is that the first quarter, we lost 1.6% in economic growth in real terms after inflation. The second quarter came in at negative 0.6. So two negative quarters of gross domestic product will technically tell us that we're in a recession. However, the National Bureau of Economic Research, or the NBER, officially calls this recession. The language below is directly from their website. Most of the recessions identified by our procedures do consist of two or more consecutive quarters of declining real GDP, but not all of them. For example, in 2001, the recession did not include two consecutive quarters of decline in real GDP. So while there's a chance that we might not be in a recession, most of our recessions that the National Bureau of Economic Research has called have had two negative quarters of GDP. The Atlanta Fed gives a pretty good forecast and an estimate of where they think the third quarter GDP will come in at. And at this moment, they're predicting 2.7% growth in the third quarter. It's up dramatically in the last couple of weeks from around 0 to 0.3 recently. So that is good news. This is as of October 5th. And as the economic data comes out every day, they adjust this with the data. So it's likely to change in the next couple of weeks as well. But just to note that this is the current rate of forecast. So we could be out of this mild recession potentially, if this is a recession, as soon as Q3 potentially. In regards to other ways to kind of look at the market and the probability of a recession, the chance of a recession by looking at the Cleveland Fed statistic, which takes the 10-year Treasury minus the 3-month Treasury, is currently at 25%, which is up dramatically from 13% in July and 4.9% in March. With the Fed behind the curve fighting inflation and hiking rates 3% from March to September, this predictive tool is probably behind the curve as well, with the idea that usually the Fed raises rates slowly, or more slowly, in which you can see the probability of a recession increase over time. At this point, this might be one of the few times where the Fed has increased interest rates in a recession, seeing that we had two negative quarters of GDP and we started to raise rates in March. Inflation has doubled the long-term average at this point. So the CPI for August was 8.2, down from the high of 9.1 in June. And what you'll see here is that the blue line on this graph, which is the inflation using the headline CPI, which is if you eat and drive, which is the one I like to monitor, shows that in the 70s, we had some pretty high rates of inflation, all the way to the 12 and 15% marks back in the 70s. And since then, to the right of this graph, you'll notice that we've been below the 4% 50-year average trend of closer to the 2% realm in regards of inflation in the last, say, 10 to 12 years. But it's spiked up here recently and looks like it has peaked in June of 9.1. And, so one of the things we're looking at here is the idea is, can the U.S. afford these rising of interest rates? And I look at the usdebtclock.org, and I just took a screenshot last night, and you're looking at the fact here that the federal debt to GDP, our debt load as a country to our economic growth, was only 34.6% in 1980. So we didn't have nearly as much debt on the books in 1980 as we do now. So those interest rates, we could probably afford a much higher interest rate like we had. At this point, with now 125% debt to GDP, it's going to be very impactful to the budget, the interest expense moving forward, if rates stay this high and new debt comes on the books at this level. So this is something I don't think we've talked about enough, but something that is going to have to be a tough decision that the Fed and policyholders are going to have to make. My take might be that the Fed wants to increase rates right now to damp down inflation, but that they probably don't want to keep rates this high for this too much longer, just based on the idea that we kind of can't afford it. This graph is going to tell us the monthly CPI increases that make up the annual rate. So July and August are the lowest month-over-month numbers in the last 12 months. That's great news. In the next 4 months, we're losing 2.6%. The question is, what are we going to replace it with? It's a step in the right direction, still of an unknown, but you can clearly see that if we're losing some of these bigger bars or bigger month-over-month numbers in the next coming 4 to 6 months, we'll probably have some inflation growth there, but if we can keep it on the lower side, inflation will start to come down, and that would be great news for markets, bond markets, and the Fed. If we look at the New York Fed Global Supply Chain Pressure Index, that's also easing. You can clearly see here that the global supply chain pressures have decreased in August, continuing the decline observed in the last 4 months. So this is welcome news. So are we close to the end of the rate hike cycle? My take is that the federal funds rate, which is right here in 2022, went from 0 to about 3.1% when you average it out in the matter of 6 months. This is one of the biggest increases and quickest increases of interest rates that we've seen in a long, long time. And how much of this is priced in? Well, the green line here, you can see the market is expecting about 4.19% is where the Fed will land in the near term, and the Fed is estimating 4.4, so they're a little bit off, but you can clearly see that the long range estimate here, the FOMC long run projection is 2.5 on the right. So regardless of exactly how high we go in the short term, the Fed is still expecting lower interest rates over a longer period of time, and that should be good news for bondholders right now who are concerned about rising interest rates affecting current price, but also might create some opportunity to lock in some interest rates at higher prices or higher yields, for that matter, to lock in that yield for the longer term. So why does the Fed raise interest rates when inflation is elevated? Well, by raising short-term interest rates, the Fed increases borrowing costs for things like revolving debt, like credit cards, home equity lines of credit, new mortgage rates, car loans. It takes time for these rates to hit the economy, as you don't make large purchases like this every month. By raising rates, the Fed is trying to reduce demand, which since the pandemic has been out of sync with supply. For example, there were not enough homes or cars to buy last year, and with the increase in demand and lack of supply, the cost went up for both. So higher rates make these things more costly and therefore reduce demand. There's no way to put this, but this is the worst bond market of our lifetime from a performance perspective. Does it create an opportunity here for the future? I think so. This graph is showing you from JP Morgan just the Barclays Aggregate Bond Index, which is a quality U.S. bond index that covers government bonds, securitized bonds, and investment-grade corporate. And you can clearly see that most of the time, the gray bar is up or positive in some degree in history since 1976, except for this year on the right. So far, we're down about 14% or so in the bond market, and this is one of the worst bond markets in history. At one point, we even got as low as 15% down. And so the red dots are just showing you the intra-year declines that can happen in bonds. So it is not abnormal to have a negative rate of return over a certain period of time during the calendar year, but usually you end up positive. This has been one of the most trying times for bonds, but also might create some opportunity moving forward. This is the reason why, frankly, other than inflation, I mean, we're really seeing the yield curve go up all over the term side here. So on the bottom, we have term, 3-month, 1-year, 2-year, 3-year, 10-year, and 20-year government bonds. These are loans to the U.S. government that you would make. And the blue line here is what the current yield curve looks like as of September 29th. And you can clearly see that, to start the year, we had 0.39% interest received on a 1-year bond, and that has spiked all the way to 4.1% more recently. That increase in rates has caused a decrease in price, therefore affecting investors negatively, but it also creates opportunity to be buying, short-term bonds, 4% on a 1, 2, or 3-year quality government bond. It's not a bad rate of return, and one that we haven't seen in a long time in the bond market. The risk reward does look attractive in investment grade bonds, and I'll give you an example here. And this is not a recommendation at this point, but it's the idea of the risk and the reward of quality short-term bonds. I'm looking at tickers VCSH and VFSUX, which is the mutual fund and the ETF version of the Vanguard short-term investment grade corporate bond index. And so the average rating is A-. The number of bond holdings is 2,217. The duration is 2.8 years. It's about how long it takes for the maturities of these bonds to happen. The yield is 4.73. So I give the example, if the current 10-year treasury goes from 3.8 to 4.8, so rates rise 1% from here, you would lose 2.8% on the price, but gain 4.73 on the yield for a total return of 1.93. If the 10-year treasury goes from 3.8 down to 2.8, you would gain 2.8 on the price with interest of 4.73 for 7.53 total return. So the downside being about 2, the upside being 7.5. Again, the risk reward does look attractive in quality short-term bonds. This example does take into effect interest rate risk only, but does not look at the credit risk or risk of a default or downgrade, which can happen if a company has a poor balance sheet or makes bad decisions. They might be rated negatively, and that could also affect the price, and that's not being considered here. I'm just clearly looking at the risk of the Fed raising interest rates and as rates rise. So how often are stocks and bonds negative? This data on the left is a little bit outdated. It's just through the end of May, but the concept here on the right still stands true, which is the negative calendar years for U.S. stocks and bonds. And we highlight, BlackRock highlights here, in 1931, we saw -2 in bonds, -43 in stocks. 1969, -0.7 in bonds and -8 in stocks. And this year, we're seeing something like -13 to 14 in bonds and around -20 in stocks, depending on the day. So it's very abnormal to see stocks and bonds go down together. Let's take a look at valuations here for a second. This graph is the S&P 500 forward PE ratio. So it's the price of the market, price of the stock market, divided by the earnings on a per share basis, or profits. In the past, there have been moments in the 1990s where someone might pay $24. That's what 24 times earnings means, $24 today for $1 of future earnings. There have been moments in the financial crisis where we've gone down to about 10 times earnings, where you pay $10 today for $1 of future earnings. More recently, we were in the low 20s, 20 to 21 times forward earnings, and those valuations have come down to about 15 times earnings as of the end of September. The 25-year average is 16.8, so we're definitely below those averages, and usually where the last several years, we're not that far from a valuation low point that we've seen in 18, in 2020 roughly with the pandemic, and right now we're right around this 15 mark, which I think is quite interesting. So valuations have already traded kind of down to the average recession, so markets might be predicting this recession after all. Earnings have held strong with increases of 7.8% year to date. The valuations or multiples, what investors are willing to pay for those earnings, have dropped 31.4%. The average recession has seen multiples decline 32%. In the financial crisis, multiples declined 31%. So I wanted to give everyone an idea that recessions, the financial crisis, the multiple growth we're seeing right now, or detraction of multiples, is right in line with some of the worst moments that we've seen. So again, is a lot of this priced in? If the stock market's down 23% year to date, JP Morgan's telling us that 7.8% was growth of earnings, which is pretty good, and then negative 31% is the multiple. So most of this, so far, the downturn has been really multiple driven, and earnings have held in there. If we look at the bear market performance again to talk a little bit about PE contraction or valuations over here, you can see that CFRA has done a nice job of showing bear markets with recessions. Bear market is a 20% decline in stocks. So a 20% decline in stocks with a recession tends to, on average, have 15 months to it and down 35% in the stock market with a 32% decline in valuations. However, if the NBER comes out and says this is actually one of those times that it's not a recession, the average bear market is about 6 months with a 28% decline and about a 35% PE contraction. So what might be in store for earnings this quarter? I think that is going to be the big question on markets' mind. Analysts are estimating earnings growth for Q3 of 2022 to currently be 2.9% growth. So we're seeing earnings and profits of companies still grow in the third quarter. That's analyst expectations. On June 30th, the Q3 earnings were projected to be 9.8%. So we're seeing a very big detraction in the projection of earnings growth. Maybe that's because of the contraction in the economy. But that's also good news. It means that these companies might be able to beat this lower hurdle of only 2.9% growth versus almost 10% earnings growth. So despite analysts revising earnings estimates down by a large margin in Q3, companies have been more positive actually in earnings guidance for Q3 relative to the past 2 quarters. So overall, 106 companies have issued earnings guidance for Q3 2022. 41 of those companies issued positive earnings guidance. So compare that to 29 positive guidance for Q1 and 32 for Q2, and the 10-year average of 32, 41 is much better. So maybe things are a little bit better in corporate America than anticipated. We shall see. Next Friday, October 14th, kicks off earnings season with JP Morgan and Apple reports towards the end of earnings season on October 27th. So those 2 weeks should be very important to see where valuations and earnings come in and how the stock market performs. The next graph here from JP Morgan is very interesting. It shows the equity market bottom and the economy bottom and the days between and those returns. The equity market tends to bottom first. So stocks bottomed in 3/31 of 2020 at the pandemic. The economy didn't bottom until 91 days later on June 30th, 2020. And there was a 20% return in stocks during that bottoming process. So for those of you thinking I'm going to wait until the economy rebounds to invest, it's not that easy. In fact, some of the better returns that you're going to receive in your lifetime are going to come around the riskiest moments where the economy is still bottoming out. So if we take a look here at 2009, it was a similar scenario. At the end of February 2009, the equity market bottoms, and as of June 30th, 2009, the economy bottoms. That's about 122 days. And in there, we saw 25% growth in the equity market. So there's really nice returns to be had in those quarters or those couple of month periods where all looks bleak. To give some example, the average return of the stock market is about 10% long term. So to get 2 years or even more than 2 years rate of return in a quarter is, just fantastic, and one of the reasons you should remain an equity investor for the long term. So these are the returns needed to get past the high or to get back to the high in S&P 500 to start the year. Most people want to know, what's it going to take to get back to where I was? A 1-year return of 33% would have to be in store at this point for us to get back to where we were. I don't know that I have a lot of confidence in that occurring. But over a 2-year period, is there a chance you could get 16% rate of return or so for a total of 36? Possible. Over a 3-year period, maybe more likely here, 11.5% per year, 38% total return. So probably somewhere between, again, it depends on inflation and earnings and various things, but probably a 2 to 3 year window here to get back made whole in your stock performance and get back to the 4,797 that we started the year with. So there's no proven way to time the market. This graph just shows the hypothetical growth of $1,000 invested in stocks in 1990, and you can see that it would have totaled to $20,451. If you missed the best performing day, it was $18,329. If you missed the best 5 days, it was $12,917. And my guess is those best 5 days come in between the stock market bottoming and the economy bottoming, and that would create much of those returns that you can make over time come in the riskiest moments. So hang in there and invest for the long run. Do not panic. Best days tend to come after the worst. So let's take a look here in the middle graph, the return after a 20% market decline. Dimensional Funds does a great job of telling us here that if you go back to 1926 through 2021, this is a 1-year average return after the stock market goes down 20%, 22. And then there's about a 41% rate of return over a 3-year average after the stock market goes down 20%. And then the 5-year average cumulative return is about 71.8%. So therefore, this is why I think that we, somewhere in the next 2 to 3 years, we'll make our money back in stocks, because history tells us exactly that. Next, I want to shift to sentiment. The AAII Investor Sentiment, the American Association of Individual Investors, puts out a weekly sentiment survey. And the most recent 2 weeks have been very, very bearish. This is a contrarian indicator, and one that should tell you that we could hit a potential short-term low in the stock market. If we go down to history here, the historical averages tell you that 38% of people who take this survey are typically optimistic or bullish that the stock market will go up over a 6-month period. 31% of people are neutral, and 30% of people are bearish. At this point, there are double the amount of bears, from 30 to 60, in the last 2 weeks. So history is being made with this bearish sentiment. This is the first time in the survey's history that pessimism is above 60% on consecutive weeks. The survey has been around since 1987. The bull-bear spread, which is the bullish number minus the bear sentiment, is negative 40.9. It ranks among the most negative in the survey's history. So it's maybe no surprise that Monday and Tuesday ended up being pretty positive days for the stock market, just because those who wanted to sell have probably already sold at this point. Bear sentiment has only been above 60% 4 other times in the prior to the last week and this week. And those dates are August of 1990, October of 1990, October of 2008, and March of 2009. Historically, the S&P has gone on to realize above average returns and above average median returns during the 6 and 12-month periods following unusually low readings for bullish sentiment and the bull-bear spread. So how has inflation impacted consumer confidence? Well, it's cratered. And the consumer has almost never been as bearish as right here. A couple months ago, we hit an all-time low in the consumer confidence index. But what I really like here that JP Morgan puts on this graph is they'll look at the subsequent 12-month return of the S&P 500 at the bottom. So whenever you hit a low, like in October of 1990, there was a 29% rally in the stock market from this point moving forward over 12 months when consumer confidence was this low. And if we take a look forward, in April of 2020, when consumer confidence during the pandemic hit lows, we rebounded 43% from there. So again, this would tell us that, again, a lot of the bearishness, a lot of the bad news is priced in, and there's optimism ahead. What tends to happen after years in which an asset class loses money? Well, BlackRock does a great job of telling us that in 2022, most asset classes have lost money. 93%, or 104 out of 112 asset classes have lost money. They look at this by looking at the percentage of mutual fund categories that lost money in a given calendar year. What you'll also notice if you go back in history is in 1994, 80% of fund categories lost money. And what happened thereafter? Only 4% and 3% lost the next 2 years. In 2008, 94% of asset classes lost money, and only 2% in no asset classes lost money in 2010. So history is on our side, that when we get these huge bouts where everything kind of goes down at once, there's some reprieve of that in the next couple of years. Historically, have been pretty low in the things that lose money. So hang in there with pretty much all of your assets. This graph is from Ned Davis Research. It's the S&P 500 cycle composite for 2022. So cycle composite charts are designed to provide perspective on how repetitive historical market patterns could indicate a potential pattern for the current year. They look at annual seasonal cycles. So how does the stock market perform every year annually? They look at the 4-year cycle reflecting the time frame of a U.S. presidential term. In this year, they're looking at the midterm election years only. And they're looking at the 10-year decennial cycle. So how has the stock market performed in 2012, 2002, 1992, 1982, any year that ends in 2. And they put this in an equal weight, and they come out with a blue line. This is the historical pattern and perspective to which they believe that the market might trade. And until about August, it had an uncanny ability that the orange dotted line, which is the S&P 500's actual performance, versus the blue expected performance, you can clearly see that it's been pretty close. I think some of the things that deciphered difference here is there was the Russia-Ukraine conflict, and here I think you have the Fed in Jackson Hole, Jerome Powell talking about being much more hawkish with rising interest rates than the market expected, and there was a bit of a sell-off there in late August, early September. But if this gives us any idea, there could be a second half rebound in store. And as we look forward, BlackRock has some similar data showing us that if you look at U.S. stock market performance across election cycles, this is going back from 1926 to 2022, you'll see that in all years, markets have tended to go up 12%. Presidential election years, 11. Midterm election years were the worst at 8. And non-election years were very good at 14. And not only that, but when you look at the first and the second half of these calendar years, you can see that the beginning or first 6 months of a midterm election year tend to be the worst performers of any 6-month period in a president's term. The last 6 months tend to be better, and the first 6 months of a non-election year, which we're coming into, tend to be pretty positive. So maybe there's some seasonality to the market improvements ahead. So I wanted to thank everyone for taking the time to be a part of this. Please share this information with friends and family, and please feel free to reach out in regards to any questions you might have on your own portfolio or questions you might have in regards to working with us moving forward. Thank you very much, and have a great day.